This podcast has been made possible by Profix Software. On this episode of Planning Aces, we'll be featuring the FP&A insights and commentaries of 4 finance leaders, including CFO Adam Ante of Paycor, CFO Will Johnson of Iterable, CFO Ryan Van Hatten of Profix, and CFO Steve Vince of Tenable. This is Jack Sweeney, your co-host, along with top consultant Steve Player, who will serve as our co-host and resident thought leader as we seek to highlight the takeaways from our distinguished group of Planning Aces. We begin after this. Your business is evolving, and the way you plan and report needs to evolve as well. The right corporate performance management solution can help. With Profix, finance leaders improve profitability and minimize risk by automating budgeting, forecasting, and reporting, putting the focus back on what matters most, uncovering opportunities. Over 1,500 global companies rely on Profix to transform the way they work. To learn more, go to .profix.com/transform. Hi, it's Jack Sweeney, and I'm here with Steve Player. Steve, how are you?
Good, Jack. How are you doing today?
We're doing fine. In fact, I sent you a 4th planning ace. Just wanted to make you aware we were going to have 3, but I thought, hey, why not? Let's add 4th. So we do have a full plate. Hope you don't mind.
I enjoyed it. I love it. If anybody's seen me, they know I'm a man who likes a full plate. So I'm happy to have it. Happy to learn.
Well, as always, Steve, we'd like to open up by picking your brain, and we wonder if you identified a common theme here with these 4 planning aces. Is there some, what did you hear? What's coming to the surface here?
Yeah, there was a kind of a clear theme that really kind of leaped out at me as I was listening to these and going back and listening to their the full podcast and everything. But the thing the recurring theme to me seemed to be really about analytics. It seemed to be about what do we measure? Why do we measure? It had some peripheral topics about how do we measure and how do we make sure we've got good data that we're actually looking at. But it really was, to me, a good discussion about metrics and the role they play in what we're trying to do. And when you think about it, Jack, the world we're living in today is just, it's a VUCA world, volatile, ambiguous, confusing, complex, just a lot of things happening, a lot of volume, but it just seems to get more so. Every time I think, gosh, it can't get any more crazy, you think about just in the last, 3 or 4 months, with the advent of Russia attacking the Ukraine, and that's just unleashed unbelievable inflation, which we're seeing inflation that we hadn't seen in 20 years. And so you heap that on top of everything else. We are post-COVID, or we're post-shutdown, but we're not post-COVID. If you can understand that saying, so that we're living in a new reality. That this pandemic's just now like the flu. It's part of everything we have to do. It's a little bit more deadly than the flu, so you really got to be cautious. We've got vulnerable populations that are really still there. I think about that every time I pick up my grandson, and I'm happy to do that. But my daughter-in-law, and I love her for it, she doesn't let me touch that kid without washing hands and making sure we're ready. So it's just you just have to adjust how you deal with reality, and it's not it is the new normal. It is just, this is how the world goes, and so we've got to constantly be adapting and changing. The same for our businesses. We've got to adapt and change. Our employees have so many more options than they ever had before. So it's not a great resignation. It's a great reassessment. I think that was a term Brett threw out on one of your Workforce Champions shows. But I do think people have lots of choices. And so you've got to just constantly be thinking, how do I make my company the best place for these people to work? How do I make sure they feel part of it so I get their best talents, and how to collectively we create something that our customers really care about, and therefore they keep using us. So I mean, it's a challenge, and even more so, it's just you gotta step up to it.
Well, let's get rolling here, Steve. I thought we would feature Will Johnson, CFO of Iterable, as our first planning ace. During our discussion, I thought he said something interesting. He was talking about how metrics need to be consistent. So over time, your audience gains that familiarity with them and they have context. I thought that was an interesting word, audience. Within the organization, every metric has its audience.
What Will's really coming at is really that storytelling kind of approach that, in finance, we got to be great communicators. The best CFOs are the ones that know how to communicate. Well, you communicate more effectively through the use of stories. Well, you do that if your story is consistent and can follow. The advantage a CFO has is people usually pay attention to them. So you got to be careful. You got to be careful which questions that you ask, because the questions you ask, the metrics you throw out there, the dialogue you have sets the tone. And they're presuming that you're asking the questions that help your company get where it's trying to go. You've got thousands of metrics that you could look at. Which ones are important and why are they important? And what are they trying to tell you? What are you really looking for? And that's really the challenge of analytics today, is we're getting so much better at data. The digital world is so much more accessible, but you got to be thinking about, what am I looking at and why am I looking at? What's it really telling me? And some consistency certainly helps tell that message over a period of time, not just a snapshot, but I want to see the moving picture.
Well, if you missed Will's episode 794, interesting background, came up that corporate development track has had several CFO tours of duty to date. This is Will Johnson, CFO of Iterable.
Yeah, so we have, and just like you said, or reference, we do have a dedicated BI team. It's a team of about 5 folks. It works very closely with our finance or FP&A team. And those two organizations, both relatively small teams within our business, but both playing critical functions. Together, they're collaborating on both, like you again referencing some of our key operational metrics, both financial and otherwise, but they're also looking at continually what are new sources of data we might want to pursue. I mean, one that comes to mind, I was in a meeting earlier this week about, was we're always, even though I'd say the core financial and operational metrics that we share internally with our employees and externally with our board and investors, that's pretty well baked. And there's a real thought process behind that I have as to why we keep that fairly consistent and don't change it much over time. But internally, in terms of the operational metrics and better understanding our customers, we're always looking at more closely tying our customers' usage metrics to both our revenue and our cost stream. We want to make sure that we understand the relationship in both dimensions. We understand how usage, maybe in unexpected ways, drives our operational or infrastructure costs. And we want to understand where there are, of course, revenue opportunities to continue to grow and foster the revenue relationships we have with each of our accounts. We do QBRs with our BI team. So we have a regular cadence where the BI team meets with a subset of the management team. And part of that regular interaction is consistent, again, from one session to the next. And then part of it is more exploratory. So we want to, and again, I'm a big believer in, a core set of your metrics should remain consistent, in part because you want to develop your audience, whether, again, it's your employees, your investors, a familiarity. And so those metrics need to be consistent so that over time, your audience gains that familiarity, and they also have context because they look at longitudinally, well, how are the metrics changing over the time that they've been exposed to them? But you also want, and this is where our BI team does a good job, you also want that notion of exploring, as I mentioned before, around, looking more closely at usage metrics, you want to always be asking your question, well, what's the question we haven't asked and we should? And so roughly a third of those QBRs with our BI team is around just that. Well, what other areas should we go, and explore? What questions maybe are questions we haven't asked about our business?
Yeah, I thought, Will, again, about a core set of your metrics must be consistent. I think a lot of finance leaders share that point of view that too many metrics out there is not a good thing, that the audience gets confused.
Well, I agree with the kind of the core set of metrics. It's interesting the juxtaposition and the interplay between his business intelligence team and his FP&A team. That you've got two kind of closely related. I've seen those be the same team. I've seen them be separate, but it's interesting how they kind of interact together in terms of what's out there. I do agree that behind each of the metrics, everybody ought to know why. For every metric you have, there ought to be the why. Why do we look at this metric? What does it tell us? What do we look to do? And the interplay between the FP&A is trying to look, what is the corporate goal to improve your customer relationship, to improve where you're trying to get to. So the interplay between the metrics is, how do the metrics tell you if we're actually achieving our strategy? And so long term, I want to make sure that we're moving from where we are to where we want to be 3 to 5 years out. In our future ready methodology, we try to get companies to get away from this short-term fixation on the 1 year metric, because everybody gets this 1 year metric and come hell or high water, you try to meet that. You want your metrics to be midterm. You need them 2 or 3 years out so they can be significant in terms of what's there. But you want to see how they check and move toward that direction. So every metric ought to be lined up with how is it reporting on a strategy, reporting on what's happening in terms of what's out there. So I firmly agree on this concept of how do we pull it together. The second part of that, though, Jack, is also they did have a little bit of time to look at new metrics. So I think you always, you keep your consistency, and then you see where you get to with that, and then be on the lookout. Now, when you bring in a new metric, don't just pepper them. It's not like spice of the day kind of thing, okay? If you're developing a new metric, you're trying to say what you think this new metric's telling you, what the information is. But then the question is, does it become part of the flow? Is it something you just need to learn one time, or does it become part of the message that says, how are we moving toward the strategy? So in all situations, you ought to be thinking about, when I take action plans, how do I expect this to move toward the metric? And then, is it happening or not? Are we getting there or not? And if we're not getting there, why are we not getting there? Did we not get it implemented? Was it not as effective as we thought it was going to be? So you think about, really, all this is a prediction. I'm going to take these actions to move us this direction to achieve this objective. And it's going to take this amount of time. That is the forecast of where you want to go. As you execute, all you're doing is get more current information. It's like it's a ball game. You expected the ball game to go this way. It's playing out. And is it working the way you thought it was going to? And if it is, great. If it's not, what do you have to change? How do you adjust your tactics? How do you adjust what you're going to do? How do you adjust your action plans in terms of what's out there? So that's how it kind of all comes together here for me.
Thank you, Steve. Our next planning ace is someone who I think maybe gave you a little bit of a jolt, Steve. Adam Ante, CFO of Paycor. Now, I have to say, he was brought into Paycor as initially, I believe, as a vice president of analytics. But I believe the CEO and the board tasked him with making Paycor data-driven. It was time. The organization had a sort of a traditional finance function, and Ante arrives to really, I think in many ways, shake things up and get people looking at the numbers. This is from episode 799 of CFO thought leader Adam Ante of Paycor.
Yeah, I've always seen I've always wanted to create and I've always wanted to have and be part of a team that I sort of affectionately call a Black Ops team. I want our team to be more of a Black Ops team. We can deploy anywhere, we can do anything, we can drive the organization, and we are setting the pace for how the company needs to perform. And I think people do get a little, I should say, folks in finance and accounting tend to recoil a little bit when we say, hey, we as finance leaders own the outcome of this thing, whether that's new sales or channel development or improved retention or operational effectiveness. They tend to put their hand up because it's not as easy to say I own those things. But I've tried to build a team. I've tried to bring people in that think like that want to own the outcomes and not just be a reporting function. Other people can report, and reporting is the easy part, but figuring out how we can partner with folks, that we're making the right decision alongside the business leaders, and that the outcome of those decisions are not for the business, they're for all of us to own. And that's the culture that I've tried to create. That's the culture that my leaders create. And we bring folks in with that expectation. One of the things that we do is we've built culture statements for our finance teams. And it's sort of a series of 8 sort of statements that really speak more to how we do our work rather than just, generic things about our values, but more how do we want to show up every day? What are the things that you need to do as an analyst or an accountant or a business intelligence leader so that when you show up in these projects, we're not just reading out things. We're not just doing what people tell us, but that we're challenging the business, we're challenging the pace, and we're setting or we're taking ownership of these results as an organization together. Yeah, as you can imagine, there's sort of unlimited metrics to pull together, and so we do have access. We spent a lot of time actually earlier on when I joined the company investing in our data infrastructure. How do we manage first financial data most effectively, and then operational data, and now into customer data? We're really focusing in getting into the customer data to make sure to see if we can pull additional insights out of that. And that data office has been critical for us to be able to, especially go through the IPO, but to manage the business and to continue to execute, day in and day out. And one of the things that we had done really with the beginning of COVID, with the onset of COVID, is we really flipped the company to drive urgency as well to daily metric monitoring. And it's not always beneficial to look constantly at daily metrics as you think about long-term trajectory of the company. But in this case, it really helped us to understand what is happening inside of our portfolio to our customers every single day so that we could try to respond and react as quickly as we possibly could. And this has evolved a little bit, from the financial portfolio side and understanding potential impacts to cash flow to even more operational understanding and customer service, customer experience, our ability to implement our software and get business stood up quickly. So we still continue to look at those metrics on a daily basis. Yeah, I think the first thing that you have to do is come together on the master data management side. What do you want this piece of data to say? How do you calculate it? It's almost every solution is not a technical solution or a finance solution or a question. It's a business question. What should this metric really say? And then you say, okay, now where does that data come from? How do we access that data? And you have to challenge your teams to force it into a construct. And earlier on, we didn't have the funding or the budget to go build a multi-million-dollar, out of the box stand up. We didn't have the talent for that as well. And it took us a while to really get into this cadence, but it began with the master data management. This is a booking. What is it? What does a booking mean? How do we quantify it? Where are we going to put the data so that people have access to it? And then how are we going to get other people to stop, reporting on the Salesforce report and use our data, use our reporting? And that takes a long time. It's a cultural shift. And by the way, you're running at 1,000 other things, and sometimes it's hard to affect that faster than others. We've made a lot of progress since then, but that's as we sort of continue to grow for sure.
Jack, let me pause right there for a second because it's interesting because Auntie says something that I don't know that a lot of people agree with. I think it's highly controversial in that, I mean, some people may say he watched too much NCI Special Victims Unit or something, too many Marvel mystery movies. It's a bold statement that says, I want my FP&A team to be a black ops team. I want to be able to go anywhere, do anything, and own it. I mean, that is about as bold a statement as I've ever heard a CFO make about what you really, really want. And I certainly admire his courage. I certainly admire his desire. I'm really going to be interested to see how this plays out over time, because it's a much more proactive view than we typically see. In most situations, finance comes to be the partner, but it's asking to be at the table. This is a different approach altogether. This is asking. This is the special op teams coming in and said, hey, we are ready. We're going to help make this happen, and you need to get on board. I have seen something very, very close to it before, and that was at probably the company that I think runs budgeting better than it. The only company I have ever seen that was really, really good at budgeting. If you believe in traditional budgeting, and you and I have had long conversations about this, the only company that I can report on that does budgeting really, really well is Emerson Electric. And I was fortunate early in my career when I was at Anderson to meet one of the guys that was the CFO of one of their $3 billion divisions, a guy named Bruce Eckhart. Bruce ultimately became the corporate controller. And so I got a very good opportunity to go and visit time with Bruce and really understand Emerson and what Emerson did. It was a very special relationship, one of the most interesting one of my career, when Bruce showed me kind of what Emerson did. And Emerson is a company that I have studied them. I've done a case study on them. I took Dr. Chuck Holmgren, the noted cost accounting professor. He and I went in and interviewed them. Walt Galvin, their former CFO, who became vice chairman of the company, hosted a best practice visit I did there with the APQC. So I have studied them extensively. They do budgeting, and they have something similar. In their situation, when you've got this really strong corporate budgeting culture, and the business unit is, they can describe it as tough love. They come in and they basically challenge the ideas, challenge the plans, everything. But what it is it is love. It's not animosity. It's not meant to hurt anybody. It's meant to basically make sure the plans are well tested, well vetted. And they have a system that works extremely well for them that they have perfected over 40 or 50 years of literally doing it. When they make an acquisition, they're welcome if you want to bring your new ideas. And they will discuss those new ideas after they discuss the 300 schedules that they're going to have you fill out. It is tough love. It is rigorous. Because of their corporate structure, they are upstream and downstream. And so when the corporate guys come in and ask questions, they're asking from a point of view of a lot more information. And they're doing it to share that information with the business unit to make sure that these ideas are fully vetted, that you understand all the risks. And at the end of the day, when you come out of these meetings, the CEO writes a memo that describes what was discussed and what was agreed to. It is a coming together. And the plans, when you walk out, if you're a business unit person, you're not out there on your own, because corporate owns that plan too. Why? Because they put it through the grist mill. The whole purpose of that tough love is to make the family stronger. And so that it's an interesting. The only thing about Emerson that I'll also share with you is, and this came up because we asked the question 3 times to make sure we heard the answer right. They could give us no example of the Emerson system ever leaving Emerson, in that basically that extreme discipline that they have, that rigor. They rarely would find anybody able to actually replicate that. So they have a problem sharing it with anybody. They've actually written about it in one of their books. They didn't have a problem sharing that because it is that difficult to do in terms of what's out there. Now, Adam's got a kind of a different approach. He's coming with a Black Ops team. It'll be interesting to see how it goes. But literally what you're trying to do is have FP&A really helping the captains steer the boat and really say, we can take those objectives. We can make those things happen. So it's a much more aggressive, forward-looking FP&A approach than you typically see. And it's kind of refreshing because it is really kind of that background, I think, that you see in terms of what's out there. So it'll be interesting to see how this comes out.
Yeah, I think the mindset he shared is really about the challenge of converting the organization to being data driven. That he arrived, he had a traditional sort of finance function, and also this organization is not, an enterprise organization just yet. It's a mid-sized firm. It's growing quickly. The functional groups are not all that bureaucratic. I think the approach he's talking about is perhaps well suited smaller companies. And again, I think this is more about driving transformation, I believe.
Well, again, to me, it's again putting on steroids some things that we've talked about. Finance really needs to understand the power we have with the questions, with the questioning capability. The questions you ask set the tone and they drive the culture. You ask bad questions, you're going to get basically going the wrong direction. What Adam's trying to do is make that FP&A team really drive the right way. Be the black ops team. Be agile. Take the hills. Basically, be ready to attack. Be agile. And when I've heard it described in terms of the change management technologies for it, it's the ABO continuum: awareness, buy-in, and ownership. On any given idea, the first thing you do, you're kind of in the dark, you don't know anything, you learn about something. You become aware of a new technique, a new approach, a new way of doing something, and you have an awareness of it. You can describe it, but that's kind of one level. It's just general awareness. As you move further in there, what you're looking for is people to not only be aware, but to move to buy-in. And in buy-in, you're really focused on, hey, I'm aware of this, and I think lean is going to help us attack this. I think moving to a digital world is going to attack. I think the Internet of Things, whatever the opportunity or improvement idea is, you really kind of go for there in terms of kind of what's that buy-in. But you really want to drive all the way to the third level, the ABO. The O is the ownership. The ownership is, I'm not only aware of it, I'm not only buying into it, I'm going to own it. I'm going to do whatever. And owning means when it doesn't quite work the way you thought it was going to, you're going to figure out how to adjust it, figure out how to fix it. You got to drive it all the way there. And that ownership is that full level of accountability, that fully trying to drive it. And if you're trying to win a seat at the partner table, I can't think of a better way than being right there with the operating people. You just got to be careful that you don't overplay that. They gotta, you can't get out and own it and they not own it in terms of what's out there. So you gotta come to that Emerson Electric approach where there's that joint ownership that we have come together, we have agreed on the plan, and we're all going to work to make you all want to be in the same boat, row in the same direction. We're going to go all make this happen in terms of what's out there. And so we're going to need that with the kind of storms that, the volatility that we're running through, as we talked about earlier in the program. The storms that we're in right now, we need to have everybody able to quickly come together. And we're not going to talk about much of this issue, but you got to have a lot of trust for that to happen. You got to have a lot of communication, and you got to make sure you all go ahead the same way.
Well, we're going to jump to our next planning ace, and that will be Ryan Van Hatten, CFO of Profix Software. Now, on episode 801, just recently queued 801, he gave a wonderful overview of metrics, just giving great detail and explaining so clearly, Steve, and I think you listened to the episode as well.
The thing I will say, I did want to comment quickly on Ryan is, he is an extremely interesting CFO in that he's been at Profix over 17 years. I mean, this is a guy that literally came up through the ranks. So his kind of journey to CFO is to me is unusual, but kind of groomed, kind of knows anything. He's a guy that I think probably more than anybody else knows the business because he's been working. I mean, you look at his career, he's moving throughout the business doing different things. So he's probably as versed as anybody in terms of how to get there. So.
Okay, this is Ryan Van Hatten, CFO of Profix.
Yeah, for sure. The biggest things that we're focused on as a business are growth, for sure, and then efficiency as well. And it's not really as simple as looking at your financial statements and saying, well, growth means your revenue is growing and efficiency means your profitability is growing. We look at it in a slightly different way. For a software company and a cloud company, it's not unusual to look at things a little bit differently. So the way that we kind of track our growth, at least, is in terms of ACV, or annualized contract value, maybe known as ARR, or annually recurring revenue for different companies. But essentially what that's measuring is, how much recurring revenue do we have in the bank that we can count on every year? And that's basically the crux of the SaaS business model. And the reason that it's great is you go into a year knowing already, hey, I don't have to sell all of this again. It's all sold. It's out there. People are using it. So we focus on ACV and the growth on that. It's one of the key metrics that we look at. Besides the amount of new ACV that we're selling them, the other key half to that is how well are we retaining those customers? It's pretty expensive to go out there and find a new customer when you consider all the marketing costs that go into it, allocating all the sales costs and other things. It's actually way more efficient and way cheaper to keep a customer and to sell to that customer potentially. So a couple of the key metrics we measure there are retention focused, one being the gross retention, which, in its most simple form is you go into a year with $100 million of ACV or ARR. How much do you come out with from that base? Do you come out with 93 million, 90 million, 50 million? That percentage is your retention rate, your gross retention rate. So in our case for Profix, just to share some of the details, we have a really good retention rate. It's really high. It's up around 93% for us. And that's something we focus on very closely. The other part of retention is your net retention. This one is a little more complicated, but it's measuring now how much are you losing through that churn that happens versus how much are you selling into your customer base. And what that really tells you is, hey, over time, if I sell nothing else, my ACV is going to continue to grow or it's going to decline. So the goal of any SaaS company is to be above 100%. You want to just keep that number growing no matter what else is going on in the world, no matter what else is going on with sales. It's a critical metric for us. We measure it meticulously and we break it down in a lot of different ways. And positive news for us, it's actually at 108% right now. So that implies when we can have an 8% growth rate on our recurring revenue, even if we sell nothing else. So that's how we look at growth. If you think about the efficiency side of things, yes, margins and profitability, EBITDA are important to us. We look at a few other kind of unique metrics that are kind of SaaS specific, I would say. One of them is we look at our lifetime value of a customer. So that is basically taking a look at how much profitability will that one customer generate for you over time, over their useful life as a customer, which is based on the churn rate. And how does that compare to the acquisition cost, the cost of acquiring that customer? So getting into those kind of unit economics, you find a ratio between those two things and basically a payback period. How long does it take to get the investment back that you've invested into getting the customer? And we measure that one very meticulously. It's a very important efficiency metric for us. There's something else out there with a catchy name called the magic number that a lot of people focus on as well. That's basically saying in the most simplistic terms, how much sales and marketing expense am I expending to bring on the new ACV or the new recurring revenue that I'm looking at today? And you want that number to be as close to 1 as you can get it, ideally. For every dollar you're investing, you're generating $1 of new revenue. Not always the case, very difficult to get to a number like that, of course, but that's the goal that people kind of point to generally. One of the key things that we're actually talking about right now, totally in line with everything we just discussed, is, okay, now let's take a look at our long-term plans and say, we're looking at, we want to get to this ACV target. We have a target of whatever, X number of ACV by 2025. We can now say, using some of those metrics I just talked about, what is it going to take to get there? And is it practical? And what I mean by that is, hey, let's look at our acquisition cost, our average size per customer. If that results in, let's say, 2,000 customers that have to be added, and we look at our acquisition cost and say, well, it's 100,000 per customer, are we going to be willing to spend that much money on sales and marketing in the next 3 to 4 years to get there? And the answer is, heck no, we can't afford to do that. That would destroy our profitability. But that guides us as a business. Now we can say, well, we have to acquire those companies. We have to get to our goal. How can we do that? Can we increase the amount that we're charging those customers? Maybe. Can we acquire them more efficiently? Almost definitely. That's where we see a lot of room to grow. And I think where a lot of companies can probably improve. And I would also make the leap and extension that the CFO at your company is probably the person to really spend the time thinking through problems like that and helping find solutions for them as well.
So interesting. I want to share a comment here. I had posted on LinkedIn a video of Ryan's response here. And I ask him a question and he shares this response. Now, on the video, there was a comment underneath posted by a CEO of a company who wrote, "My peer CEOs, some of whom raised 10 to 100 million in 2021, have changed their CAC, customer acquisition cost, burn projections drastically starting this quarter." So it's clear in the current environment that quite a few finance leaders will be taking a hard look at some of what Ryan was just exploring with us.
Well, to me, I was impressed by the depth of the answer in terms of, all our SaaS companies are going to talk about annual recurring revenue. But the way he's broken it down is really kind of the deeper insight. It's going deeper into the predictive logic, if you will, of kind of what's there. They're looking at what recur, and that's the reason SaaS companies are so profitable. You essentially rent software. You don't purchase it, you rent it. So that you're going to pay for it every year. So if they get a customer and it delights the customer, then you get it's like a rental property. You get basically you've got this annual stream of rents coming in. It's annual recurring revenue. So not understanding what that is, and then understanding how that relates by customer in terms of customer size, in terms of what's out there. Really, the retention rate, obviously, everybody was going to focus on that. But looking at to see kind of not only what percentage are you retaining, but of the base that you're retaining, are you able to grow it so that, yes, the customer says yes. I mean, everybody says, okay, we're still doing business with that customer. But when you're doing business with that customer, what's his rent doing? Is it going up or is it going down? Is it staying stable? Okay, the only way you're going to get to go up is you're going to sell more units to him. You're going to penetrate deeper. You're going to cause him to want to consume more, and therefore the recurring charge is going to be higher. So they're looking at the efficiency of not only did I keep them, but how much did I have? And so in their situation where they're growing 8%, they not only kept them, they recovered what they had lost in the kind of deterioration out of the 100% base. They'd gone to 93, so 7% traded away. But of the 93 they kept, they were able to grow that to 108 on the original base, so that you've got 7 plus 8. I'm not doing the math exactly, but basically got 15 points of growth within that base. So that tells you how much, once I've got these customers, can I keep expanding? Can I get a bigger share of wallet with them? Can I do things to do that? So again, and then you come down to there in the back half of the discussion, he gets into kind of the efficiency and gets into looking at that. What is it? To me, the quintessential question every business ought to know is, what's my customer worth? What's the lifetime value of our customer? When I get one, how much is it worth? And compare that to the cost of acquisition of a customer. Okay, and this situation is his 1-to-1 magical ratio. If I spend $1 marketing, I get $1 revenue, but that $1 revenue, I get it year after year after year. I'd spend as many dollars I could buying a dollar worth of revenue that came back year after year after year in terms of what's out there. So that's the reason these businesses kind of go. But looking at that, if it costs me $100,000, I can't go add 2,000 customers because that's a check no VC is going to write. So what am I looking for? I'm looking to make my cost of acquisition more cost effective. And so again, this is translating aggregate concepts like analytics down into very practical. How do you get them? What's the techniques of recruitment? How do I get past the financial into the physical world in terms of what's out there? And that's where this thing, I think, really, kind of triggers in and comes together is just the interplay between those two and understanding kind of what's out there. In every business, FP&A needs to understand this. I call it the algorithm of your business. You really need to understand what your numbers are and what you're trying to do to change those numbers, because you've got a goal out there that's big and hairy and audacious. And it takes more than getting somebody to agree to spend money to get there. You've got to become more effective at your marketing, your acquisition, your cost of service. You got to have the products and features that make it more attractive to the customers. So that's where all that comes together and turns into hopefully profitable financial statements in terms of what's out there. So very, very interesting, deeper dialogue than we've seen in many cases.
And for those who might want to take an even deeper dive, be certain not to miss episode 801 of CFO Thought Leader, where Ryan Van Hatten shares his finance journey. Actually came up through the operations side, wore a variety of hats. Interesting company, Profix, founder-led, and recently acquired by private equity. Interesting story, the way Ryan shares it so vividly. Okay, we're going to move to our next planning ace, who is Steve Vince, CFO of Tenable. Now, this goes back a ways. This is Steve Vince joined us back at episode 787, but he shared a piece of his journey, which I think was uniquely FP&A, and I thought it was worth sharing here. And then he has a few comments about metrics. Again, Steve Vince, CFO of Tenable.
Well, I realized I was at E&Y for a little over 5 years, and as I mentioned earlier, that was good experience for me. But I wanted to plant the flag somewhere. I wanted to become part of a company. And so with that realization, I decided to leave the firm and work at a company called Snyder Communications, which was an NYSE listed company. It was an advertising and marketing services firm. I was there for 4 years, and the growth there was pretty explosive. We grew from 80 million in revenue to almost $1 billion. We acquired 45 companies in 3 years. I was in the accounting department, but I spent a lot of my time working with the corporate development team, evaluating acquisition targets and conducting due diligence investigations, a lot from an accounting perspective. Well, one thing there happened that changed the trajectory of my career, and that is we bought so many companies. Eventually, we figured out that we need to start integrating the companies to achieve the revenue and the cost synergies. And the COO there took an active interest in my development and asked me to co-lead our post-merger integration efforts. So there I was working with the COOs of the integrating companies, and we were developing a post-merger integration plan. And great experience for me. It helped me connect a lot of dots within the business and look at the business cross-functionally. That means you are identifying cross-sell opportunities and making sure that you have the right compensation plans to reward and remunerate people for selling the combined offering, identifying cost synergies too and redundant costs. I gained valuable operating experience and developed some operational chops, and that would serve me well. And that led me to my next gig. I would say yes and no. So yes, I'm still looking at the same 3 numbers because those are very important numbers, but I'm also looking at other indicators of success to see if demand's changing, one way or the other. And so as a tech growth company, one of the big areas of investment is in sales and marketing, building a global distribution capability. And so looking at all of these data points are really important. Understanding your sales force, what's the achievement rate on the quota that's assigned? What is the participation rate? How many reps are achieving goal? How many reps are achieving and reaching their on-target earnings? What's our close rate? Unit economics is probably the offset to sales rep productivity, which is, what's it cost for us to land the customer? What's the payback? What's the lifetime value of the customer? So those things I'm still very much tracking, but now I'm tracking them in smaller increments and I'm monitoring them not just like monthly or weekly, but daily, because, markets change and demand can change and consumer consumption and buying patterns can change. And so it's something you have to just track religiously. Now, the same token, on the human side of it, the people side of this business has always been very important. Your assets walk in and out of the door every day, and you have to realize that as a software company. CFOs tend to forecast the business and spend a lot of time doing that. Now we're spending a lot of time trying to forecast attrition, trying to understand its impact on our quota capacity and how quickly can we hire and backfill and even grow quota capacity.
Yeah. So some interesting insight there. Again, attrition, workforce retention is quite an issue. We've been hearing about it on our other Workplace Champions podcast. But here, he's tasking the planning team with the impact it's having on the company's growth and future. Steve, what did you make of?
Well, I like that, and I like particularly the way where we have this set. Okay, if you take Van Hatten's discussion, Vince is in the same discussion, but he's back further upstream. Okay, so he's not just looking at those metrics and understanding those metrics. Now he's understanding what caused those metrics to happen, and now you're down into the daily work. The who makes those sales all happen. Well, they happen because some sales guy on the quota out there is making calls and following up and making things happen. And so he's gone from, and this is a huge shift I see, Jack, is I see this movement away from what was the old line of finance where we're looking at months and quarters and years, and we got this kind of backward-looking, slow approach. And we spin around and start talking about operations, and we got to look forward. We got to see what's coming at us. But we're not looking in months and quarters. We're trying to see things happen. We're looking at trends. We're down to weeks and days and trying to see things. So I see that the biggest trend I see with all the analytics we've seen is we've got so many more ways to measure things. Now, we've got to be careful when we got so many more ways to measure that we don't slip into the problem of listening to the noise. Okay? So when you look at daily measures, you're going to see bounces. You're going to see things spike up and down. And the first thing you got to do is you got to begin to understand that up and down, in many cases, is just noise. You don't know. It's just random variation that's not signaling anything other than, hey, we live in a spiky world. So you have to understand what your trends are. You have to understand what your control limits are. So if I get a really big spike up or down, I know to look at it. If it's little spikes, I just know it's normal noise. Okay. And what I'm looking for is when the spikes start recurring on top of the line or below the line, the trend line, signaling the trend is increasing or the trend is decreasing. Those are when I start to figure out, okay, what are the real signals coming out of this thing? But again, it starts with looking at it. But what he's looking at is just the realization that these aren't numbers bouncing up and down. These are real people making phone calls, talking to customers, and real people have real lives. And sometimes they may decide to go to work for somebody else or to quit work or whatever. So he's looking at the capacity. Well, if you lose a key salesperson, that's like think about if I was in the manufacturing world, that's like a machine going down or a part of the operation shutting down, and that's going to contagion and impact other parts. So literally when they go down, what he wants to know is what capacity have I lost? How long is it going to take to replace that capacity? Because I can't just plug a new machine back in. I've got to go find the right person that can fill that sales job. I've got to get them hired. I got to go through the process and get them hired. I got to get them oriented. So there is, when you lose people, getting a new person in there and getting them up to full speed is a lengthy process. So again, this is things that can be modeled, that can be anticipated. You can look for strategies that says, hey, I know on average I'm going to lose about this many people. So even though I don't know where they're going to go, I can be hiring in advance of the expected loss in terms of so there's different strategies that you can use to mitigate things, but it's all about really understanding the predictive logic. It's about really understanding what's really happening with your business and feeding that against the real signals so that you can literally steer the ship. So the analogy of you're constantly adjusting for what's really happening is really where this is. And that's where I think Steve is. I mean, what I like about his background is that really, if you think about it, tremendous amount of trial by fire, okay? He's at the accounting firm for 5 years, and he goes to a company, and in 4 years, they go from $80 million to almost $1 billion. That is a ton of acquisitions, okay? But anybody can buy something. How do you make it operate productively. Well, that requires merger and integration and synergies to be harvested and everything. So that you can literally see his career follows where he positioned himself in companies that were creating needs for where would really pull his career forward. And so for your listeners out there who are interested in navigating their careers, look for the company that's going to pull you in ways that allow you to accelerate quite rapidly. I'm sure Steve had lots of different opportunities he went through there. He certainly made some good choices to kind of get to where he is at a fairly young age in terms of what's out there. But that's because you're aware of, you're thinking about, you're learning from podcasts like this about how people handle these things, what their tools and techniques, and then how do I plug this in? And we're seeing, and the reason I like this series is we're seeing not only talking about logic diagrams, but where we're going now, we're getting out there into the front lines of what's happening. What are we anticipating? We're anticipating turnover. We're anticipating what that's going to do to reduce our capacity. We think about how long does it take to bring that capacity back online? What mitigation strategies can you deploy to make that all happen? And so you see this stuff kind of pulling together, and that's what real FP&A teams do. They're out there, they're working, they're literally helping the company deal with everything that's coming at them and get ahead of it. So it's happening, but it's like the weather. It's the waves breaking. It's happening, but because we anticipated, because we got ourselves future ready, we knew it was going to come. We knew what we would do to respond. And as it happens, we're responding and taking advantage. And we do that better than the other guys. We're gonna be the company that comes out on head. And so, great example.
Since the pandemic, is it? Can you, when it comes to scenario planning? Since the pandemic, have more CFOs beefed up their scenario planning? Have they really taken seriously having this component in their risk management?
I think more, Jack. I think more CFOs are certainly aware of it, but CFOs are aware of a lot of things, and they're getting hit by a lot of different things. So I think they're more aware of it. There's more action in that direction, but I don't think any of them are moving. There are a few of them that are moving as fast as they need to. But it's like, when you're getting hit from 18 different places, the one you choose to respond to, you kind of work where you think the toughest part is. And to really do scenario planning, you've got to be very proactive. As Stephen Covey would have said, that's a very important job, but it's not urgent. When it becomes urgent, there's a whole different set of things you got to do. You can't really think through. You got to respond to the fire. So the more things you do that are important that aren't urgent, the more you'll avoid that in the future.
How about this? As far as company size is concerned, is scenario planning a luxury for companies under 100 million in revenue? I mean, is it unusual that you'd see a CFO who said, "Nope, this is part of what we're up to"?
I think the smaller the companies are, so under 100 million in revenues in terms of size-wise, limits the number of finance people you have. But it also limits how complex your response needs to be. So I think if you focus it, small companies can be agile by just thinking through. You just have to be quicker in terms of thinking about your plan. And you also have to realize, as a smaller company, your playbook is not as infinite as a bigger company would have. You've got less things to pull on. So when you've got less things to pull on, it's like playing 6-man football versus 12-man, versus 11-man football. There's only certain things 6-man football can do. I don't know if you play 6-man football in New York, Jack, but basically it's a game with a lot of passing and running.
But isn't it, since you're smaller, you can be agile, though. You don't have to move
You're a whole lot faster. It's a whole lot easier to get 6 guys doing what they're supposed to than trying to get the whole. Yeah. It's a whole lot easier to instruct. So you have to turn what some people would say is a negative. You got to flip that around and turn it into a positive.
Serious scenario planning strategy. What size do you see companies need to be before they're really executing something of substance when it comes to scenario planning? Seems to me that most mid-sized companies, they just don't have the financial, the resources, the finance talent to dedicate to such a thing.
Well, I think, Jack, if you view financial planning, if you do scenario planning the same way you do annual budgets, you're lost to begin with, okay? Because you're spending way too much time on annual budgets. If you get to a rolling forecast where I'm continuous planning, I'm always looking forward in terms of what's out there, all you're really doing after you got to light touch, understanding where you're going, where I'm steering the ship, is just say, where could this ship take dramatic differences? Okay. And at that point, it's easy to pull out and say, okay, let me work on this scenario. What would happen? And again, because you're a smaller organization, you can be more nimble in your responses. You've got less plays to run. In many cases, your scenario plan is realizing that if that happens, we just got to run naked through it. We don't have a plan. We don't have a way. We just, and so the beginning, you realize, all right, how do we shore that up? How do we begin to have a strategy for what we do? So it's thinking about the one thing about scenario plans is also scenario plans are not an annual budgeting exercise. So once I put out a plan, I can update that fairly quickly. And I don't have to do it on an annual cycle. I can update every 18 months. I can update whenever the significant changes are. So it's the thinking through that makes you future ready. It's the fact that we've actually thought through some things. And so if I use trigger dates to tell me what I should be thinking through, it helps me kind of, learn how to adjust and understand how would we play that if that scenario came true. And then the whole thing is then when the scenario like the pandemic hitting, when something breaks that you haven't thought about, the fact that you've done 3 or 4 scenarios at least gives you a set of plays that if you quickly think through what is the pandemic going to require us to do, hey, we're going to have to curtail operations, we're going to have to raise cash. You've got at least playbooks already identified from your previous scenario plan. So I think scenario plan has huge benefit, even if you never run the scenarios that you actually plan for, because they taught you plays that you could run in other scenarios. They also taught you plays that you probably should be running more effectively for your normal operation. So I'm a big proponent of that simply because it's putting you, again, it's important work, not urgent, but it gets you ready so that you can take advantage of those things when they come.
So it really just begins with a question or a set of questions. If this happened, then what?
Where would that make us vulnerable? And what you're looking for is the gaping hole before it gets ripped. You're looking at, hey, if we hit an iceberg, it's going to be bad. So how do we make sure that we know and get yourself a bit more flexibility in terms of how you respond to that? You don't have to be perfect. You just got to be a little bit smarter than the other guy.
So, Steve, that's our episode. But before we go, I always get to ask you where you headed, what's going on, what's happening out there.
Well, I'm excited, Jack. People seem to be calling. I mean, the post-shutdown, still COVID world that we live in today, that people seem to be opening back up. I'm out seeing more clients getting called in, and love getting out and working hand in hand with people. I'll be out in Las Vegas this coming week, out seeing some clients and doing some speaking out there. It's always fun to go to Vegas, where my youngest son lives now. So always ready to go to Vegas.
We'll put that bumper sticker on your Tesla, Steve. For Planning Aces, I'm Jack Sweeney with Steve Player. Thank you for listening.